Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is June 3rd, 2025. And today on our call, we have the CEO, Bill Nardo from Pivotree. Pivotree trades on the TSX Venture Exchange under the symbol PVT, and it also trades on the OTC under PVTCF. The company is currently trading at $1.20 with 26 million shares outstanding, or about a $31.5 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Bill, great to have you back. It's been a long time since we've spoken, I think well over 2 years. So it's we think it's well about time that you came and said hi to us again. While we do know the story fairly well, I'm sure there's a lot of our members that don't. So maybe a good idea to give us a good sort of summary of what the business is all about, and then we can get into the investor presentation, any kind of updates. So take it away, Bill.
That's great. Thanks very much, Paul. The usual disclaimers as a public company. Look, thanks for having me back on the show. It's nice to come back and update everyone on what's been happening. As you say, maybe for the benefit of those of you who are hearing about us for the first time or haven't been through one of our presentations, I'll start off a little bit about what we do and who we do it for and what we aspire to do. Again, we're guided by some big aspirations and have been since really the day we started investing in the company. And then I can share some of our recent financial results and how the business is taking shape. Jump in anytime with questions. I'm happy to respond and react. I've been doing this enough now. So just at a very high level, we've got over 30 years of experience. We're really experts in making commerce smoother for businesses worldwide. So we work with 125, 150 globally recognized customers in retail, distribution, manufacturing, and really trying to provide solutions that eliminate friction in commerce. We've got somewhere close to 500 employees spread around North America, Europe, and APAC. And that really is ensuring we have the right expertise in all the right places. And we'll talk a little bit more about our service catalog in a sec. So it's really this end-to-end integrated services around commercial transactions is what we focus on. We're not a payment company, so again, I'll manage my language carefully. You'll see from the service catalog what it is that we do and who we do it for. So really want to start with talking about our vision and our mission. This is a vision that isn't just us, that we're leading. We believe that the world is going to be a world of commerce that's frictionless. We've been watching this transformation over many years, and it's just been this again step towards getting what you want, how you want it, and really this is all being aided by technology. If you think about our mission now in helping create a world of frictionless commerce, we really want to make it easier for businesses to optimize the find, trust, buy, get, and keep through the adoption of innovative solutions. And so, again, breaking that down for a second, is really we're describing any commercial transaction. You've got to find what it is you're looking for. You have to trust the information enough to buy it. It has to get to you, and you have to choose to keep it. And what you're going to hear about through the course of what we do, each one of those steps really requires good data in order to be able to complete and fulfill this transaction. And so our goal, our mission, make it easier for our customers to deliver that to their clients. There's 4 ways we talk about winning in this space. One of them is just having the right skills and abilities in the service areas that solve frictionless commerce. And this tends to be our pro serve and our managed serve businesses. And we'll talk a bit about that in our catalog. We really strategically apply emerging tech. So AI, machine learning. 30 years ago when I first started in tech, the emerging technology was the internet. And you didn't have to build internet infrastructure to take advantage of the internet. In fact, it was knowing how to use these emerging technologies to change business. Same thing here. Like, we're not an AI company building large language models. We are a company that practically applies AI and machine learning to our pro serve and our managed service processes to solve for friction. What really will help us win long-term is where we can take number one and number two, skills and abilities, with the emerging tech, turn them into products and services. So really, you'll see, again, this evolution of we're working with, packaged applications, we're solving customer problems, we're finding innovative ways to do that, and then we're layering in productization to make it even easier for our customers. And at the end of all that, we'd like to have connective tissue between those products and services. So this is our vision and our mission. It's really what guides us. And that leads us to kind of the catalog part of this conversation, which is, okay, what is it we do exactly? Well, we have three flavors of offerings, really: professional services, managed services, and legacy managed services. Our managed and IP solutions really are the products that we're building, the IP that we layer on top of ProServe and Managed Serve. Our professional services really is about systems integration. It's about really understanding your requirements, gathering requirements, and then using some of these selected technologies at the bottom there to solve your problems. Legacy managed services, and we refer to them as legacy only because they're older technologies that are really in their final stages. You're not really growing this segment anymore. People aren't buying more Oracle Commerce, but those who have it are really trying to eke out the last bit of life from those solutions. And so it's a declining part of our business, but it's profitable. And it goes back to, some of these customers have been with us a decade and are on technologies that will eventually leave. We try to move them onto some of our newer platforms, but that's where our legacy managed services has been a slowly declining business. We'll talk a little bit about how that's affecting our valuation. So again, we play in commerce, which is really that UX, UI piece, the shopping cart, if you will, the search and find component. We play in data management, which is really about making sure the quality of the data across all the different elements of that transaction are good. And then the supply chain is that process of getting it to you. So that's our business in a nutshell: ProServe, Managed Serve, and managed IP solutions, and across a set of functions in the commercial transaction. You didn't hear me talk a lot about payment gateways. So again, just being really clear, when we talk about a commercial transaction, it's all of the processes involved to get that product to a customer, but we're not a payment gateway company either. Let's talk a little bit about our financial summary. This is kind of where we are today. We've got a really healthy balance sheet, $6.5 million of cash. We did have a subsequent event that we reported that bumped that cash further. We've got a line of credit available to us. We aren't really using any debt today. We've got consistent EBITDA. So the last few quarters have been positive. Adjusted EBITDA, the only adjustment we make is non-cash compensation. And so the margins have been in the 9 to 10% range. And Q1 was the first quarter we delivered net income. We've got momentum, so we're growing in our managed IP solutions business. We've had really good growth in bookings, and we're starting to see the revenue come up behind those bookings. And we've been an effective allocator of capital. We've done some good M&A over the years, clearly have proven, to be the right kind of price. And we recently did a divestiture of one of our legacy managed services business, where we were able to generate, 2.5 times revenue for that business. So we've done quite well with the way we allocate capital. We do have really good sticky customers. You can see the kind of average tenure they've been with us. And while we had a modest uplift in enterprise value, we were trading a little closer to $1 for the longest time. We popped with some of our latest news. There's still lots of room to improve that. I think, we're at 0.3 times revenue and 3.1 times adjusted EBITDA on our run rate right now. If you look at our comparables, and this is, again, one of the reasons we wanted to come have a chat with you guys, is if you look at where we were last year, we were always trailing behind the EV to revenue versus our peer group. You could argue we were quite a bit ahead at 18 times EBITDA, but as we started producing that, magic bottom line, you can see we've now come in well underneath what the peer group would be trading at, closer to 10.6, and we're at 3.8 times. So we think there's good opportunity for people to pay attention to what we're doing, see some of the things we've been committing to, and make decisions for themselves when the right time is. But obviously, we think our business is worth a lot more than the price that you're seeing today. And really, that enterprise value is overstated because our cash position is a bit higher as we reported than what came out of Q1. I get a lot of questions, both from current investors and prospects, about, well, what's going to change? What's going to drive the inflection? Everybody can nod in agreement and say, it seems like a really undervalued business. I won't make you go looking for the issues. I'll tell you, what we've been facing for a while. Three things are going to drive the inflection. I'm going to start with the middle one, the aggregate revenue growth. I think one of the things that's really pulling us back is our aggregate revenue isn't growing because of our legacy managed services. So you do have to, and we started to disclose this, you do have to pay attention to what's the PS and MIPS business doing and how's that business growing, knowing that the legacy managed services is going to continue declining. Once aggregate revenue growth is present, I think we, then unlock the real turnaround. When we see bookings really start to accelerate in those other core growth areas, and they start to exceed the declines in legacy managed services, then we start looking more like the growth tech company everybody expected. So that first one is a critical piece of an inflection, aggregate revenue growth. I wouldn't call that first, Q1. I think we did 19.2 million. It's a bump up versus Q4. Lots of good things happened in that quarter. I think that's still a bit of an anomaly with legacy managed services coming off. We need aggregate revenue growth. That's going to be one of those big inflection points. The second one, though, is the product and technology breakthroughs. We're actually working on a couple of things and have been for over 2 years that can really accelerate some scalability in our core products. And I'm going to talk about one of those products today, but that R&D could be really disruptive. And that's what we think is one of the hidden gems, including, our library of digital assets we've been building. So that could be another inflection point. And then return to acquisitions. We've got cash on the balance sheet. We're producing cash. I'm a lot more comfortable using a line of credit for acquisitions if we're producing cash organically. And I think that could help accelerate the top two items. So these are the three things that are going to drive the inflection. The technology breakthrough we feel is just around the corner, and the ability to get back to acquisitions is starting to ramp up. So these are all things that I think will drive a more reasonable perspective on our valuation. I talked about this a minute ago. The most important leading indicator to watch is that yellow blue stacked bar on the left. That's the professional services and the MIPS. And how are those things trending? And if you look at those, from a growth perspective, the last couple of quarters are showing some of that positive total core growth business, right? So 12.5 to 15.2 to 16.6, 15.2. We're in the right kind of bookings areas for MIPS and PS. You're going to see the light blue continue to decline on bookings, and that means it's also going to decline in revenue. But those are the legacy piece of the business. So we are seeing good bookings growth. Really love seeing the MIPS. The MIPS were signing longer term contracts, which means they're having a slower impact on revenue. But I like long-term contracts because that's how you start building compound growth. So again, you pay attention to what's happening in our bookings. That's going to be the best leading indicator of when you should expect to see, aggregate revenue growth start to kick in. But profitability is, now table stakes. You got to have it. You've got to have, cash production, I think, for anybody to pay attention. And in the next two slides, I can show you that in spades. But we've been tracking fairly consistently on our gross margin numbers. You can see the big turnaround on net income and EBITDA. This is what we expect to be running at. Again, I'll save you hunting around for how did that happen. Q4 last year was, it was announced we'd made major changes in Q3. We cut $8.5 million of OpEx. And so you can see the impact of that now on how the business is run. So, no magic. Like you do what everyone was doing for the last 12 months, get your costs down, become leaner, become more efficient, and you start producing cash. And I think that's probably what spooked some folks at the end of last year, was it looked like our cash was starting to decline. We knew what the drivers were. We were very clear Q1 would see a correction. You can see that at the end of Q1, we went from 3.9 to 6.5. But you can also see with the sale of that legacy managed service, it's well up over 8, and we're continuing to produce cash. So good, healthy cash flow, good positive EBITDA. And as I said, a couple of key pieces that'll lead to the inflection. Before I go into the product, Paul, did you have any questions you wanted to ask me about the financials?
No, I think I'm good right now. We do have some questions that some of the listeners are asking, but we'll save that till the end of the presentation. We might follow on some financial questions then.
Okay. The only product I really want to talk to you about today is really around our data segment. And one of the things we've been building, which we talk about in most of our circulars and most of our presentations, is SKU build. And I'm going to actually try and show you, because sometimes it's hard to explain these things, but when you see them, it makes more sense. So if you think about SKUs, these are stock keeping units. These are products. Every product is a SKU of some type. And if you think about simple SKUs like Coca-Cola, a can of Coke, Coke has many different flavors with different ingredients, different sugar contents, different caffeine. They have attributes that describe that SKU. And when you think about the number of SKUs that are unique, it's a few hundred million. But when you think about how many people are selling those SKUs and might have a unique way of presenting it or sharing information, it takes those 300 odd million unique SKUs and it bumps it up into billions of SKUs. So when you look at the number of existing SKUs across North America, there's about 7.4 billion existing SKUs. Every year, 1.8 billion get updated. And then 1.4 billion new SKUs get added. And over on the right, what you can see is the various costs associated with this. So bringing a new SKU, 1.4 billion SKUs to market, that can cost upwards of $40. And when you think about bringing it to market, we're not talking about, the cost of putting the package and the label and filling it. We're talking about all the information required to go into all the systems to make it available for sale. That includes QAing it and making sure you don't get into trouble misrepresenting it. It costs you about $2 per SKU per year to update and govern those existing SKUs. And then there's really a method for cleaning up all that information. And the goal for us is to highly automate that. And our goal across all of this, if you look at, $40 at the high end, $2 to update, $6.50 to introduce existing SKUs to new channels. So maybe you've got it on your website, but you want to clean it up and make it available for Amazon. Our goal has been to automate the heck out of this process using machine learning and AI. And on some segments of these 7.4 billion SKUs, we actually have the cost down to about 10 cents. And that's through high degrees of automation and AI. Using generative AI, we can start lowering the cost of creating romance copy, translation. This is really about the size of a massive market of managing what historically has been a very manual process. Why is it important? Well, go back to the very first slide we talked about. You need to be able to find something. Well, you need to be able to search for it. It needs to show up. The quality of the data determines whether it shows up. You need to trust the information enough to buy it, so it's got to be complete. And then it has to properly reflect what it is you're buying so that when you get it, you choose to keep it. All of that data drives conversion rates, it drives traffic through SEO, it can increase your average order value, it can reduce returns, and really it can also be faster time to market, so bringing these products through your channels quicker. Now, I said I was going to make it easy to understand it, so I'm going to give you a really simple example. On the left, you can see a distributor that carries a couple of different products from various manufacturers. And we go through this, we call this the dirty data product gap analysis. We find this all the time with our clients. You can see that they're represented quite differently. A voltage range that is described either spelled out as volts or with a V. You can see type, analog for OTC, but for the other two, they don't even have a type. You can see works with for OTC. So OTC has a bunch of good information and then a bunch of blanks in the other manufacturers. If you're doing a search for 6-volt batteries, well, Schumacher and Westward won't come up because the information isn't present. Same thing with battery compatibility. Again, we don't see works with and compatible being the same thing. So if someone were to type in works with, they'll find OTC. But if they type compatible, they're going to find Schumacher. This is dirty data. It's incomplete. It's not formatted in a consistent way. It's going to affect search. It's going to affect search optimization. And the goal of fixing that It's not a new goal. This has been going on for decades. As long as there's been digital channels where you need more information available, people have been filling this information in manually. You can see on the right what clean, complete product data looks like, right? We've now standardized the voltage range. We've filled in all the types. We've made compatible the go-to rather than works with, and we've got all the rest complete. We've also added another dimension on color, which is for search engine optimization. You can imagine romance copy now being able to be generated for all of these as well. We've automated a lot of this process on the right. Now, there's still some really hard to automate processes. Those are the R&D breakthroughs I'm talking about. Work that we do on with our various partners in the AI world to work on extracting and completing this data in a fully automated, low-touch way. So again, if we go back to that first slide, billions of SKUs that can cost multiple dollars per SKU, we're talking about a massive market opportunity. And we're showing a way to automate that, get that cost down, and really create a way to corner the market in clean and complete product information. So we have tools like Dive, which is really about data and process automation. It auto classifies, it deduplicates, it creates that SEO optimization, and it can also do AI assisted content generation, sentiment analysis, and more. So this is really our AI team and our machine learning team that is leveraging all the various tools out there to go after a very specific problem and automate it to a degree that none of our competitors do. So an example of where we put this to work, a very large MRO subscribes to our SKU classification normalization. So they're one of the largest in the business. They do 14 billion in sales. They've got 330 locations. They manage 4.5 million SKUs. They require 98% accuracy on all their SKU data. And it's very manually and time consuming to do it the old way. Now, we enrich 400,000 SKUs for them per year. We ensure 98% accuracy. We fully automated this process for them. What started as a Canadian, trial turned into a North American and is now moving to a global. Because again, this process of automating this gets them to market quicker and cuts their cost down rather dramatically. So SKU build is an example for us really of how we use machine learning and AI, automate a manual process, lower the cost. We've actually built a library of completed SKUs. So, while we're talking a lot about a process, we actually have digital assets now that become available for sale as well. So that, again, rather than having to go and capture that information, we've already got it and we can start selling from the library. We don't talk about it a lot because it's really only just started and we've only started getting into our first resale of the library SKUs. But those are the kind of breakthroughs, again, that, when you see them start showing up, they represent great revenue and margin potential for us. Because again, that SKU that we've cleaned for customer A is probably sold by 10 other customers, and there might be some nuance for each of those 10. Generally speaking, it's the same SKU for all of them. So this is really a great leverage point for us to acquire it cheaply and resell it multiple times. That's us in a nutshell, Paul. Like this, the summary really is we've got a healthy cash position. We got great positive EBITDA we're starting to produce. We've got a segment of our business that's starting to grow. We've got some great hidden gems, with the R&D breakthroughs, the digital assets. And again, I think probably the biggest opportunity is, we are overlooked and undervalued for, anybody that likes small cap, which we clearly are today.
Awesome. Fantastic, Bill. Thank you for that. We do have some questions that are coming in, but a reminder to everybody, if you've got some other questions you'd like me to ask Bill, please use the chat function and I'll ask the question. So you have some legacy business. I always love these businesses that transition sort of with call it a stayed old legacy business, and then you've got a growth driver inside. Maybe reflect on how long do you think it takes before that legacy business is more or less a non-event, or is this something you think will be around for quite a while?
It's an asymptotic curve, right? Every time we think it's almost done, somebody signs up for another year and just extends the life. I know there's, some people that are still servicing Unix, servers in banks, right? Like the good news is, generally speaking, the longer they last, the more you can charge because there's fewer people around to do the work. So, we don't mind having them around. The problem is, again, every time they come off in chunks, they can come off in sizable chunks, and you see that, hit in the next quarter's revenue. We've planned as if it's gone. So for us, achieving our EBITDA, it really doesn't require the legacy managed services to continue. While they're here, we'll continue to generate margin on them. But I would expect over the next 24 months, you'll see it getting a lot closer to zero. You'll probably see it come off in bigger chunks. We've been pretty clear about that with anyone who comes to our quarterly updates. It's been a little bit softer for the last couple of quarters. This year, we'll see some pickup on it. But it still won't go to zero this year. It'll just be less important. And I think we're getting almost to the point now where it'll be small enough coming off by the end of the year that we should start to see aggregate growth made up in the other categories.
Now, you mentioned inorganic growth in the past. You've done some acquisitions. How do you view that now? Like, are you actively out there looking at stuff? And if so, what sort of things are you looking to add to the business?
Yeah, I would tell you we never stopped looking. I think the challenges of having our currency be so devalued and also seeing a cash balance declining really limited what we would be able to do. Now that we're growing cash, we don't even have to think about using our stock as currency. So we're seeing more opportunities start to come up. We're very focused though. I know anybody who was paying attention when we went public, we kind of got screamed at for not deploying the capital faster and coming back to recharge our balance sheet sooner. It wasn't long after that when the capital markets imploded and we did a couple of really smart deals that people were like, "Oh, good for you for being patient." It's our nature. We're going to be patient. So, don't expect us to come reeling off 3 transactions anytime soon, but we are actively looking. And I think with the balance sheet we've got more potential now than we did 6 months ago or a year ago.
Now, this question is going to sound like I'm looking for some sort of forecast or something, but like you obviously you have internal goals. What kind of growth goals do you have for the business? I'd say on an organic basis. What should investors kind of expect as far as this type of business growth?
Yeah, I'm going to go back to you have to disaggregate, right? So take legacy managed services out and whatever declines, and then just look at MIPS and look at and professional services that aren't legacy and say, what is a healthy growth number today? Look, I think we're getting back into the growth segment. I think we are looking at 5 to 10% is, our goal for 2026 to be on a run rate. You should see that starting to show up in bookings by the end of this year, right? And when I say that, I mean, like, if you don't see it by the end of the year, then, the revenue is not going to grow at 10% if bookings aren't starting. We're seeing some good, healthy pipeline adjustments. The only reason I've been really cautious about any of this, Paul, is, I hate to fly in the face and be too contrarian with all the uncertainty happening in the US. It's like really hard to say how that's going to impact our business. And I'm not blaming tariffs. I'm not blaming, anything for knocking the wind out of sails. There's just a malaise and an uncertainty that seems to be lingering for everybody. I wouldn't call this a euphoria market for anyone. And so I'm cautious about, what would we like to see? I'd like to see 20% growth. What am I prepared to commit to? Look, I think we're going to be, single digit end of the year, and we want to start seeing ourselves get back into double digit growth next year.
I mean, you partly answered my question around tariffs and just the economic sort of situation right now. But what do you think are the drivers that might affect your business that investors can kind of watch for? And I'm talking in general, like not necessarily directly in the business, but
Yeah, I'll go back to what we were talking about a little bit before. There's inflection points. If we in this economy can bring a highly automated, low-cost process to a highly manual, expensive process, I think that could be one of those inflection drivers. So we've got a collection of SKUs today that are cheap and fast. They may not be quite at the standard we need them to be really widespread. We are a couple of sprints away in our product development initiatives that could get us into breakthrough. That could be one of those first major signals of accelerated growth because it's automated, it scales easier. I'd say the professional services business scales like people businesses do scale, right? They're a little bit slower to grow because you rely so much on people. If we can get that into solid, single digit growth, be happy. It's the product initiatives when we hit breakthrough those represent the greatest growth potential for us on an accelerated basis. And you'll see that again show up in the MIPS bookings. You could see a couple of those show up. We had two really good MIPS bookings in a row, quarters, on the back of SKU build. We see that potential continuing. And then again, if R&D unlocks it and we can really go after an aggressive, eye-popping price, I think we could accelerate even more.
And then, Bill, what sort of keeps you up at night? What challenges are you facing right now for the business?
Look, I think the couple of big challenges that I continue to observe in tech is adoption. When you're trying to change people's behavior, even if you've got a really compelling and demonstrable product that improves speed and quality and cost, you're still talking about behaviors. People are used to doing things a certain way. And we still find this challenging. Even our PS side, I'd say one of the biggest things we experience with customers is they really underestimate the challenges of change management, right? And just getting people to adopt new processes. I think people are a little nervous about AI and machine learning. I think some people are resisting change in that category. And sometimes you got to be careful about putting that too front and center. You got to talk about outcomes. You got to talk about, in some cases, how do I augment your team, not replace your team? And so it's really finding not worried about the tech, actually. My team's pretty smart. I think they're getting breakthroughs all the time. I worry more about, are we getting the messaging right on how to convince people to try it, how to convince people to embrace it and use it, because there's always going to be people who are worried about what it means for their job in there. And I think we're in for a few years of that in front of us as jobs start to transform.
Gotcha. Why don't we jump on some of the questions that have come in? We've got at least one individual here that's done a fair bit of work, so these questions might be a little bit more in depth, and we may have covered them already, but I'll jump on the question anyways.
Sure.
Rahil asks, the company's done a great job in cutting and maintaining operating expenses in Q1 25. When can shareholders expect growth in revenues?
Yeah, I think that's, what we were really flagging through this whole presentation, right? Is that's the last point of inflection that's required, I think, for us to get back in everybody's good books is when you see aggregate. We're already, I think, showing growth in the growth segments, but in aggregate, it's being overshadowed still a bit by our legacy managed services. So two things, one is you start seeing those bookings really start to pop, which they haven't yet. I mean, intellectual honesty, they're growing, they're looking good, but they haven't popped enough to overcome the legacy declines. I think the second thing that's going to, make it clear we're growing is when that legacy managed services really starts to flatten out, and we can then start to show quarter over quarter, year over year growth on a less important revenue mix of legacy managed services. I think, you're seeing the bookings coming in the right place that shows good growth potential. Now needs to convert into revenue, and it needs to be bigger than the legacy managed service declines. I'm not going to commit to a quarter because that would, put me offside, as we both know.
Exactly. Again, I'm going to ask these questions just as I read them, so we may have covered some of this stuff, but my apologies if we have. Okay, so Rahil also says 86% year-over-year growth in Q1 on managed and IP solution bookings. Can we expect bookings to grow at the same level? If not, what growth percentage is realistic on managed IP solutions?
Yeah, and I've been really, I try to be intellectually honest about these things. I put them in my CEO letters. MIPS is in that category. It's lumpy. And so what we find is we now have a couple of very large, managing multi-million SKU catalogs for customers. And, what happens right now is we will sign a multi-year deal with customers. And what makes it lumpy, again, is you land one of those, you book it for 2 years, and it drives your bookings up, and then it takes you a couple of years again to work off that backlog as you execute. And so I think there's probably two parts to Rahil's question. One, are you going to keep the bookings levels up? And two, when will you see it convert into revenue? The revenue conversion, again, is happening at a slower rate because these are good long-term contracts rather than PS contracts. You book them and you tend to burn them off in 6 months, 9 months. So I actually like having a healthy backlog. It makes our revenue predictability better. So yeah, you'll see conversion. It's going to be slow into revenue. Do I see the bookings continue? I do, but I don't see it being like a smooth quarter over quarter we're still in that stage where, it might take us 6 months, 9 months to land one of these big customers. They come in with a couple of million SKUs, and then it has a big impact on bookings. So the thing I've been trying to really track with more integrity is a trailing 12-month booking number. So this one looks great at 85%. It's one quarter, but if you look at it more on a 12-month trailing, it's like 17%. And I think that's a good, healthy growth number. And it's reflective of the lumpiness, between quarters.
Yeah.
I think the 17 to 20 is a nice number to think about for a trailing 12 bookings growth number.
Yeah, no, that makes sense. Okay, next question. Since professional services backlog is almost flat year over year, is it fair to assume getting new clients has been a challenge?
In some categories, I would say it's a transformation of the kind of projects we're getting. I think what we're finding is, we're on the tail end of big transformations from like Oracle ATG and commerce to a VTEX or a Shopify. You're getting into smaller projects now on commerce, as an example. The question is, what other projects are we doing for customers? How and where are we seeing the growth coming from? We have changed a little bit our go-to-market, and I'm going to even use the SKU build example in this category too. What we're finding is landing new customers is really a lot faster when the initial project is smaller. And so if you start with a small project, get them more familiar with you. If they're a new customer, brand new to you, and so we're seeing smaller bookings on new customers by design. And in part because in this world now, I think we're finding a more prove it to me mentality. And then when you prove it and you become a valuable vendor, you get opportunities to build your pipeline with a customer for future projects. So that example I just gave you, one of the customers that, again, was new with us for SKU build, 2-year contract, they've actually come back to us and said, we'd like you to go twice as fast, and we have more work for you to do. And so that our experience is, land smaller and expand. And that's been kind of I think the big change in this market and this economy. So it affects, no question, it affects, what your pipeline and bookings looks like if you compare them to previous years where we had much bigger initial projects coming out of the gate. So no, it hasn't so much been a challenge getting new clients. It's the size of the new clients is smaller now than it was in the past. But I'm actually fine with it because, again, the faster we get started, the sooner we can get into, expanding with these existing customers.
How do you even find customers? Like, what's the sales process and like maybe a sense of sales cycle? I mean, you said some can be long based on the size of the initial contract, but how do you get them to begin with?
Variety of ways. So we've got a number of different things that we're doing. One is all those partners that you saw that we work with in each of the domains. We're a very trusted partner with all of them. We do very good work. We often take on very complex. We often get given other people's failed projects to help clean up. So we've got highly skilled folks that put us in good stead with the vendors, the software vendors. The next thing we do is we do a lot of our own marketing. We've got a very, very capable small team, lean team, but some very strong messages that are allowing us to generate significant pipeline through our own marketing initiatives. And then, the third thing that I would say we do is we've become more industry verticalized. So, yes, we've got a history in retail. We've got a reputation. We get some great leads just by being, known in that space. We've been growing though, really in what I'll call wholesale distribution, manufacturing in B2B, because we've been very focused. So, we're going after some segments. Ironically, a lot of our software vendor partners don't go after on their own. They've been intrigued by our go-to-market strategies there. They've been coming along and supporting us as we enter these categories that are a little bit further behind, frankly, than retail when it comes to digitalizing or digitizing their sales channels. And we've had a bunch of success in automotive and industrial goods manufacturing and electronic component parts. So that's generally how we go to market today.
And what does the competitive landscape look like?
What's interesting, Paul, is when we go to the big conferences, like if you go to a retail conference or, B2B online, these older, well-established ones, the floors are littered with competitors of, various shapes and sizes. When you go to an industrial goods conference, sometimes we're the only people there that are talking about technology. And
Mhm.
so it is interesting. We're finding more places to go where there isn't a lot of competition. We're becoming much more familiar with the specific problems they have in their industry. We can speak their language. We know where the friction is for them as they go to transform to digital channels. We're having a lot more success going where the competition isn't.
Mhm. Fantastic. Um, as investors looking at the business right now, what do you think are the key? You mentioned bookings and a few other things. Where do you think, where should we pay the most attention to as far as metrics or catalysts going forward to understand how well the business is going?
Yeah, I think of the remaining pieces when we go back to what we were talking about from a what's going to create the inflection. You look at where we
Mm,
are today. We got lots of really good things going for us. The only piece that's missing is kind of the revenue. So, that is really the place to look is bookings. You will see
mhm,
what our revenue is going to start looking like by following our bookings and understanding the bookings mix. Um, we had really good Q1 2024 and Q2 24 because large legacy managed service bookings happens. But I caution people then, like, don't look at that and go, oh, they've hit a turning point. No,
yeah,
those aren't the ones you look at. Look at the MIPS. How are those
mhm,
bookings coming? And look at the professional services. That's your best leading indicator of how revenue is going to shape. I issue a CEO letter and I talk about it every quarter. What's in the mix, and how should you expect those bookings to convert to revenue? So we
mhm,
try to be pretty open about what you're seeing in the mix of bookings as well.
mhm. Fantastic. And lastly, Bill, any key message, anything you want to make sure everybody walks away with today?
Yeah, again, I think more than anything, Paul, we wanted to come and have the conversation of maybe it's time to just start paying attention a bit.
Mhm,
We're not saying, hey, poke you into action just yet, but we wanted people to hear what we've been doing, the changes we've been making, the signals that they can be watching. We'd like to be on people's radar. I think we've done a pretty good job of being open and honest about our business, where the growth potential is. We're in a really healthy place. We got
mhm,
cash, we're building cash. We're
mhm,
producing EBITDA. We got some great customers. We're in a segment that's going to have tailwinds for years. And so, this is a good business to pay attention to. I think a lot of people are still waiting to see, show me the revenue growth. That's, the
mhm,
last piece of the puzzle. And, my only message there is once we have that, everyone else will see it too. So, the key is picking your spots, right? Of
mhm,
when do you think we've really turned the biggest corners that are going to drive a re-rate? I think we've gone a lot of the way there, but I recognize revenue is king once you're profitable. We're
mhm.
profitable. Revenue is now king.
Absolutely. Well, it's helpful to know where to pay attention and sort of what to keep our eye on. So we appreciate that. We've been speaking with CEO Bill DiNardo, CEO of Pivotree Incorporated, symbol PVT on the Venture Exchange. This has been great, Bill. It's great to catch up, and hopefully next time we won't wait 2 years to get you back on.
I'd love to be a more regular participant in these, and thank you so much for sharing your audience and for having some great questions for me. I really appreciate it.
Awesome. Appreciate it so much, and bye for now.
Bye bye.